Today we'll be discussing Congress proposing a new expanded income contingency repayment plan. So I'm going to go over what are the existing plans and what are the proposed changes to the plan, even though it's not absolute yet. What is the future of federal income-driven repayment plans? Okay, this is what the video is about. If you like this content or are benefiting from a federal program, please subscribe to the channel, comment, leave your questions. We try to answer every single question. That would greatly help our channel. So first and foremost, I'm going over this article because this article does a good job in summarizing. I will put in more nuances from my own experience of LoanSense working with thousands of borrowers on what we think will happen. Okay, so more nuance to this November 5th article. But essentially right now, I'm going to go over what are the current plans. The current plans are the famous income-based repayment. That's the oldest repayment plan. That is inclusive of all loan types, not just direct loans, but FFEL loans. Then there's pay-as-you-earn and revised pay-as-you-earn. They treat married couples differently, slightly differently. One allows you to include your spouse, another doesn't. Then they also calculate a percentage of what's called right here, the adjusted gross income differently, right? PAYE and REPAYE allow you to count 10% of your discretionary income. And it's slightly different for parent plus loans. It's EICR, which is 20%. IBR is 15%. That's why when loan officers or lenders are automatically telling people to go to IBR, I'm like, no, that's actually not the best plan because it's 15% of the discretionary income. If someone can avoid that, they should go for PAYE or revised pay-as-you-earn. The current plans, if you're not a public servant, which means you're not working for a nonprofit, government, school system, is 20 to 25 years. Biden has already changed the rules such that if you are on a regular loan forgiveness program on the 20-year plan or 25-year plan, that they will be exempt from any type of taxation until 2025. And right now, Congress is looking to make that permanent, which means all loan forgiveness will be tax exempt if they're able to change those rules and make that permanent, which we're on a pathway to doing that right now. So that's a good first step, right? Making it tax exempt. But what Congress is doing now is they want to unveil this new expanded income contingency repayment plan, which they're in negotiated rulemaking right now, which means that all the details of the program have not been set yet. But here's what is anticipated that I want to review that's in this article and that I want to add a little more nuance to. They're speaking to a lot of different people to make these rules. Essentially, we're still going to allow current existing plans. So if you're on ICR, revised pay-as-you-earn for direct loans, you don't need to move out of these programs. So it's not like they're saying, hey, if you're already in a program, move program. So they are not saying you have to, but they're going to give you an option if it's better for you. Once these rules pass and expanded income contingency repayment becomes a thing, LoanSense software and advice engine, along with our advisory services, will update to give you the best up-to-date information on what you should do, by the way. So if you're one of our clients already, just know we're on standby here to assist you. If you're not and you come into these decisions, just know we're here to help you. What they're trying to understand right now in the married borrower situation is if you're married, they haven't decided yet if they will always have to combine income regardless of tax status, kind of like revised pay-as-you-earn does right now. And of course, which by the way, our view is such that if you are making less money than your spouse and you don't want your spouse's income to count towards your payment, opt for pay-as-you-earn and not revised pay-as-you-earn because you don't want your spouse's income to count towards your student loans. However, if you make more money and your spouse makes less money and you have fewer student loans and perhaps, married couples can also have a different strategy based on percentage of income and who has more loans. So one can opt for revised pay-as-you-earn, another can opt for pay-as-you-earn. It's called like a double taxation loophole. We've helped married couples make decisions around which program they should go in to best benefit and lower their aggregate or total monthly payments. So anyways, we help strategize around that as well. So expanded income contingency repayment, it would be great if they could simplify the rules by just automatically making it be whatever actually requires less payment for the borrower without the borrower having to strategize it. That would be ideal, right? Because then it could help everybody, whether they need to consider joint filing status or separate. But I guarantee you the government will not be that generous. So until then, we're here to help you decide what you should be doing to lower your student loan payments appropriately. Okay, payment amounts really quickly. The existing formula right now is uses different adjusted gross income percentages of that right now. So they're negotiating right now on how to build a marginal approach. And essentially what that means is the percentage of your adjusted gross income will be based on your income. It's almost like a progressive taxation policy where the more money you earn, the more the higher bracket of taxes you pay based on that part of your income. It's a little complex, but the point is they're trying to decide if they're going to make it like not straight, everybody on this plan gets 10% of their adjusted income, gross income, or everybody on EICR gets 20%. They're going to make it marginal, which is like the percentage is based on your income level. So the more you make, the more percentage of your adjusted gross income, not total income, by the way, you would pay. So they have not detailed like what that marginal rate is going to be yet. I think that defeats the purpose, though, of simplifying the process because, I mean, people are already confused enough about which plan to choose, even with a flat adjusted gross income calculation. I don't know how they think making it marginal is going to simplify it. That is my frank opinion. But I don't make these rules, but I'm happy to write actually a letter to them to let them know that this is not simplifying the approach. This is actually making it extremely painful. And this is why our taxation system and yearly filings is like people's worst nightmare because it's too complex. There's too much to do, too much to manage, right? So I disagree that this marginal approach is simplifying the student loan program. That's my opinion though. Okay, so let's talk about interest benefits. So the idea is that your monthly income driven plans are lowered, but there's still monthly interest accruing, right? So basically, let's say your payment was $500, now you pay $100, $400 is apparently still accruing, right? They're deciding right now the percentage to subsidize that $400. So on revised pay as you earn, it's subsidized by 100% the first 3 years, and then after that, they subsidize it by 50%. I would say that if they want to simplify this, they need to make it one rate, make the qualifications clear who qualifies for expanded income contingency repayment, make it one rate, do not make it marginal, too complex. And I would say that the government should subsidize straight across 50% of everything that is accruing year over year so people's student loans don't grow and have a growing balance and have to wait for forgiveness. That is my frank opinion on how to simplify this. Give everybody 50% subsidization of that interest, that $400 month over month that the government said we'll subsidize $200 every single month. And at the end of the year, you get a statement that says you have gotten $200 times 12. So that's $600. $200 times 12 is $2,400. You've gotten $2,400 of interest forgiven from your student loans. And they could just tell you that. In order to get an additional amount forgiven, you have to refile your paperwork and make it very clear what the purpose of filing your paperwork is. And it is to get that interest subsidy month over month, right? The government needs to do that to improve the system. Otherwise, people get lost in this process, don't understand, and think, oh, well, I can afford my full payment. I'm not going to file now. But what that's going to do is all that interest that the government's supposed to subsidize will now capitalize, which means it will be added to your principal balance, whatever you originally borrowed. And that needs to stop right now. The government needs to stop that because that is harming borrowers. And so I am 100% for simplifying this process. I am 100% for more transparency on what the government is subsidizing, interest subsidy, month over month. That is what I call these programs. But the government is making it way too complex and too unclear what is happening with people's student loans that they get lost and they don't understand what's happening. And they're like, well, I'm not going to file because I don't need this program, too much work. And then negative things happen. So please, take filing deadlines extremely seriously. They are there for a reason because you don't want that interest that the government's supposed to be forgiven added on top of your principal, and now your payment's going to increase. So LoanSense is here to support you on this journey. We've seen borrowers make these mistakes. Interest capitalization, which means interest added onto your principal that is interest accruing that is now added to your principal, will negatively impact your opportunities and chances of buying a home because guess what? Your balance increases. So if a loan officer is using 1% or 0.5%, now you have a higher balance. We need to get you into an appropriate income-driven repayment plan with a lower payment amount and help you properly manage these loans. Or if you have a high student loan balance, you will never be able to buy a home. That's the reality, especially if you're earning a moderate amount of money. So if you have more student loan debt than you do annual income, you are extremely at risk of making student loan errors that will literally exclude you from home ownership. We are seeing people, I don't want to say exclude you forever, but you have to fix the student loans in order to buy a home or in order to really move to your next financial aspiration in life. So please take these student loan decisions extremely seriously. People don't understand how serious they are until they mess up and it becomes hard to fix. So the more money you owe, the more you need to speak to someone or the more you need help managing your student loans from a strategic standpoint. We help with paperwork, but we're also extremely strategic. So if we can help you understand, what is best for your student loan situation, especially if you're married and both spouses have student loans, even if both don't, but you have dependents, you have big financial goals, you want to buy a house, you want to consolidate your credit cards, whatever you want to do. Understanding your student loans is very important to helping achieve those big dreams. We are 100% here to support you. MyLoanSense.com. We work with tons of lenders who are educating on how student loans impact debt to income. So ping us. Let us know if you need help. MyLoanSense.com. Our support, by the way, once you purchase a session, you will have a dedicated loan advisor who really understands student loan policy as well as mortgage credit rules. We also have, lenders that we work with that are trained on student loan rules and understand student loans. So let us know if we can be of assistance. Please subscribe, like, and follow this channel. Thank you.